4 a.m. in London when I'm doing this market update. Uh, Most welcome to join me in the chat box. I can say hello. I've been away for about a week's time. We had the bank holiday, and then as well, I was on holiday actually. I spent about a week in Greece, in their lovely islands, and enjoying their good weather and good food and good hospitality. But I'm back in London now. We're gonna take a look at the charts. I actually just cleared everything out, so we're just working with blank charts. It's quite nice actually, to take a few days off and then come back and try to see things from the from a clean slate. I did do some trading, and I'm actually still doing some trading. As you know, the stock markets have been declining with the S&P 500 and the Nasdaq, so I still hold a short position in the Nasdaq, and I'm also short the French stock market. So that's pretty much the only thing I've been doing trading wise. Otherwise, I actually haven't been looking too much at the markets. I have followed a bit of the news, so bear with me if I don't know all the details. But the chart itself reveals really the mood, and that I understand. Okay, good. Let's begin, and let's begin with the euro. So the euro is moving upwards here. So I think what's happening in general is that because of the stock market turmoil, the euro is acting a bit like a yen. So you're seeing the euro gaining slightly on the euro on sort of global market turmoil, right? So that I think that's lifting the euro upwards. Now, the challenge here right now is that you have like central banks across the world are cutting rates, and now people anticipate, or they have been anticipating for quite some time, that the US are going to cut rates. And the current situation reminds me a lot about the situation in 2000 and was it here 2008, 2017? Sorry, 2000, yeah, 2008. Um, when everybody sort of started cutting rates and everybody sort of started to engage with some quantitative easing and things like that. Because what happens is that when you have world economic growth and world economy is gaining, you see high stock markets and things like that, then people start to say, okay, which is the most interesting pair to put your money in? So you get a bit of interest rate, what we call the carry trade. Because if you imagine you have two banks, right? You have HSBC and Barclays. One pays 5%, the other one pays 10%. You need to lock up your money for 1 year. There's no difference. There's no risks. Everything is just normal or the same. The only difference is just the interest rates. Then usually you go to the one with the higher interest rates, right? That's where you would deposit your money. It's the same thing here with the banks sorry, with currencies. But what's happening? But when things are good, you go into the currency that has the highest interest rates. And for a long period of time now, the dollar has been sort of what's been dominating. Like for example, if you look here in the Aussie dollar, this is a weekly chart by the way, so it switches to a daily. So for pretty much since 2018, the Australian economy has been weakening, and the central bank has been dovish in Australia. At the same time, the U.S. central bank has been very hawkish, and lately here we saw acceleration in the downtrend, so the dollar did do quite well at one point, but now everybody's, even though they already priced out any rate hikes of this year, people starting to price in more weakness. And let's actually take a look at that. So let's load the CME futures. So next meeting is in 15 days, and the current rate at 225 to 250, there's a 79% probability that that remains unchanged, and at 20% or 20.8% probability that they're going to actually cut rates by the next meeting. And I think by the end of the year, so this is the current one. So the likelihood that the interest rate remains at the current level by the end of the year is just 2.9, according to the markets. So that's a very, very sort of different pricing because people again starting to price in some sort of a recession, or a significant slowdown in the US, which I think makes perfect sense. So in these sort of conditions, what's the preferred way of being positioned? Well, if we are gonna bet on an actual slowdown in the economy, which I think it makes perfect sense, given that the U.S. is now also in trade wars with Mexico, um, and it doesn't look like we're going to have anything good from the U.S.-China relationship anytime soon, then it's more likely that the economic data across the world will continue to be soft. And in the US, again, we've seen with the market PMIs and yesterday the ISMs, they're all going slightly lower, which is a warning sign. So I think which interest rates or which bank is going to raise interest or not, it becomes less important. Rather, people will just flock into things like the yen, they will flock into the Swiss franc. You might see gold prices higher as well, and you see lower stock markets. On the other hand, if you think there's going to be some deal, you think everything's overblown, then you obviously would do the opposite. You will buy some dollars because you think they're still not going to cut rates. You would maybe buy stock markets because you think they're going to bounce, and maybe you're going to short gold. Now, I don't like, I don't agree with that view. I do think the way things are looking right now, we'll probably have more weakness. And being short the Nasdaq 100, which I have been over the last week or so, has not been a bad trade. It's actually been a very, very good trade. And I communicated several of ideas in the S&P and the Nasdaq 100 to you guys. Uh, and the way the charts look, they do suggest that we're going to see further weakness. Now, as for this, which is the euro, unfortunately, from a purely technical perspective, uh, there's not too much to offer. Also, uh, again, from a sort of positioning or a macro fundamental outlook, I mean, both of these countries are going to see slightly dovish central banks going forward. On one hand, the market is already so bearish on the US economy, so even if they go ahead and cut rates one or twice, it might not even be enough for the market because the market is much more negatively positioned than that. At the same time, with the situation in Germany and Europe in general, I mean, maybe it's going to be a conversation of who's going to do the next quantitative easing. So maybe if the ECB would start to do more quantitative easing again, not that I think they will do, then that could potentially start to change things. But for now, none of that looks likely, right? So I think what's happening here is from a purely macro fundamental point of view, you're choosing between two markets that are probably two currencies that are not going to do either very well. So it's likely, unfortunately, that this is going to be continue to be just a very choppy market. Okay, and it doesn't make too much sense to either be bullish or bearish, and it's a very quiet market as well. So there's not even a lot of fun to do here. There's not fun. This is very difficult to make money here unless you have a system that's specifically catered for this sort of conditions. Um, so I don't think it's going to go anywhere fast. I don't think as well. Looking at this chart, it doesn't tell me anything. So I'm going to be very, very neutral and sort of because that's what the market is. There's no point trying to force it to do something. And I think we're just going to continue to be within a range here. I think people might look to sell at the highs for the price to go to the lows like that. And then, they might look to buy back and sort of do something like this. So I think it's just going to be sort of, sorry. Think it's just going to be a very choppy market. And, we might trade to the downside. So if we do take out the low, things turn bullish, bearish, sorry. And I do know people looking at this like some sort of a wedge. They're doing things like that. And then they say, oh, okay, we're going to have a massive break. And yeah, we might have a massive break at one point. So maybe when and if we trade above 113.27, could potentially start to target this high and then maybe a little bit higher here. But there's going to be a lot of time wasting, as it has been for about a year's time in this market, where we could focus on more interesting stuff, like maybe the yen pairs. As you know, in GBP yen, I did share with you guys a setup, an idea. The idea was to short sell here. I traded this myself. I didn't go for the whole profit because I was not projecting as bad data, but I'm not saying we should start to sell here at the lows either. This is a breakout that already sort of started a long time ago here. Um, but if you look into scalp, taking advantage of short-term positions, and I think even this might go up, but then eventually just continue to drift lower. Again, I'm not really focusing on this too much myself, but there are yen pairs out there where there's not been too much activity. Um, so again, euro, fortunately, guys, I think it's just going to continue to be choppy. See no reason for this to change anytime soon. As for GBP versus the USD, we've been bearish for quite some time. The market's been trading quite significantly lower to the dollar now because of the current situation. People are saying, hold on, the US might be strong, but it's economic slowdown. It's not catching up with the rest of the world. And here as well, it's a bit of a messy market. If you just look at this, we're relatively closer to the lows from December 2018 than we're to the highs. And giving to the current market conditions, I don't really think too much is going to happen here, unfortunately. So I'm pretty much neutral. Um, if you want to insist or just going to go with the bearish trend, it is still technically bearish below the 127.51, and we might just go a little bit lower here, but I think we need to clear the 24.78 level. Need to take this level out before people start to get really, really bearish, and we can see further declines. So again, the trend is bearish below this level, which is 27.51. But I think it's probably gonna sort of go down. I think it's gonna be unfortunately a bit of a boring summer. It's far more interesting. So we looked at this one. So this is a daily chart in dollar versus the Japanese yen. And I'm looking at this now for the first time in quite some time. Um, this is not good. When you need to focus too much to try to figure out what you're looking at, then it's usually not a good idea. We can say certain things though. The trend is clearly bearish below this high. So that would be the trend defining level. And the next support level is down here. We are pretty much at that level right now. Beyond that, you have the flash crash low down here. And then you have the idea, the macro fundamental idea that we're going to have continuous weak economic data going forward. So if I flip to a 4 hour now, I mean, it wouldn't be unsurprising that you can have a bit of a correction because we're close to the lows. But I think eventually we're probably going to see further declines. I think that would be the most natural thing. You got yourself your first fib at 108.50 and then 109. You have a bit more than a 50% correction, and you have these lows. So I think pretty much here, probably from pretty much 108.50, I would look to turn bearish. I think we can even reduce this trend defining level now to 109.50. So you're looking at about 100 pip stop loss. So the actual level, actually, I don't want to change. Let's leave it like that. So I think for maybe these levels, 108.60. So that will be a 90 pips stop loss versus a potential decline of about 100. So that's what I will look for. And then we'll see what happens over the next few weeks. If we take out the low, we might revisit the flash crash. On the way to the flash crash, of course, you got the 108 level, 106, sorry, and 107, which are probably good targets to get out. We're not going to cover Aussie dollar, New Zealand dollar in these markets, but we're going to cover gold. So this is gold. And gold, as you might remember, was trading within a range like that. I also said that, you know, if we take out something like the high, let's turn bullish. The market did take out that high, was 1303. I said as well, if we take out the low at 1266, the market turns bearish. Also on a CNBC interview, which was on the YouTube channel of ATFX, I said that, you know, if the markets are going to go down, the probably gold is going to go up. Now, this is by itself is a wedge sort of pattern. It's not an ideal pattern to trade. It's actually a bit difficult to trade. It's very unreliable. Um, but if we sort of look at this sort of range, some people are going to take the base. I prefer to take a spot in the middle, and that suggests that maybe we're going to revisit that high. So that could be something. And I think we could potentially see higher levels in the next few days. So we may obviously revisit and then trade upwards. Um, let's look at the 4 hour. We can also just put a fib. So let's put a fib on this like that. And buying at these highs doesn't make sense. Booking a bit of profit makes sense. First fib is down here, which also is the high here. Then you got the breakup point at the 50 level at 1303. So I would argue that probably somewhere from here, the market is going to look to turn, to create that next leg to the upside. So this is the 1308 level, and then we could potentially target 1340 and 1351, which is the ultimate target here for this pattern. Now, let's make a call here as well. Like if we go substantially below this breakup point, it's probably not going to be very bullish anymore. So I think it makes perfect sense to maybe remain bullish about 1290. So again, I wouldn't mind to turn bullish from here. Initial stop loss down here, and I think potentially upwards. This is crude oil prices, and a very decent trend. So here I had a bullish scenario, as you might remember. That one failed, and then I said if we take out the lows, we're probably going to trade lower, and surely we did. In fact, we traded substantially lower. Now let's take a look at this at the daily chart perspective. If you're looking here at the daily chart, you can clearly see how the market peaked here. It's trying to go lower. If indeed we have a proper sort of global recession, we'll be trading back at 48, $44 a barrel at one point. This is clearly a high. And I think here as well, it doesn't look too much different to something like the dollar yen. So you have a few highs here, and then this is resistance, and you can look here, you have some support down here, which we're starting to approach. Sorry. Here, this is not the time to short sell. It's the time to book a bit of profit, take maybe 50% off. And I think probably up 56.60 and then probably trade lower. And then potentially, let me see here, I'm stuck. Then potentially sort of see the market trade slightly lower. Now, the market in these conditions, like today, they can just continue to go lower. Um, if you want to scalp, you can scalp to the downside, but my preference would be to wait for some sort of a pullback. Um, let's load an actual fib here. So these are your different fibs. So I think a level between the first and the second fib, that would be good. This would be 55.39. And yeah, just gonna be bearish below this level up here. S&P. So S&P, we have this head and shoulders pattern. Goes like that. You guys just have left, right shoulder, and then you have your head. We have an unmet target, which is like that. I mean, not like that, but from here to here. I think here is what I would focus. This is where the easier trade, I think it is, given the way the data is aligning itself, given the way the world is going. I think this is sort of where I would focus on. It's clear cut. Bad data, stock market's lower. Good data, stock markets go higher. So the question is, how do we trade this sort of deal or trade? How do we protect? Um, like, where do we get out? So in case of a loss, so the market obviously traded lower, and if we trade back above this level, I think this is gonna be pretty much ruined. So no head and shoulders, and I think we can even lower it a bit. So this will be the high from May 30th. So that will be that trend defining level. And I think if we look at something like the 1 hour, that will be that level here. And I think Fib wise, we already corrected 50%, so I think this should be sufficient. So I'm just going to be bearish from pretty much current levels, and just going to look for this to head potentially lower. If we swing up above this level, it's not necessarily going to mean that it's time to turn really bullish again, but it does suggest that maybe this head and shoulders pattern it's not really the market is not as bearish as before, and it will be better time to take a step back. German DAX is up by 1.23% today, and so this is an old setup. So European markets have actually been far more resilient than many of the other markets. And the market always traded lower here. I'm not sure really what this pattern would qualify, if it would qualify to anything, but you had the break here, lows and a low and lows here. The question is here, is this bullish, is this bearish? It's not as bearish as I would have hoped for, but it's definitely not bullish. You have this little high here, which is at 11,929. I think though that's going to be hit. And then you have another set of highs here at 12,124. And I think that's probably the better level to work with. So I'm going to be bearish below this one. And I'm just going to be bearish from where we are now. There's definitely a strong push here, but we just need to sort of think about it a bit. Giving stock markets will move ahead of economic data, with no doubt. And maybe that's exactly what is happening now here. The market is moving ahead of data. So the market is in Germany and maybe France. They're seeing a low in the economy, and we're gonna see an improvement going forward. I don't really think that's the case though. I think we're probably gonna see more weakness going forward. So I would actually anticipate this to go lower again, and I don't think things are gonna improve. I think the data is gonna show that we're probably going to see more weakness going forward, especially with the new tariffs kicking in China, US, and then potentially Mexico here. I think 25% by October. So I think that's pretty much it. Let's finish up with the dollar index. So this is the dollar index, and this is your daily chart. And it looks pretty much to me like your euro dollar. So unfortunately, not a great time to being euro dollar trader or just a pure vanilla FX trader. You need to look into more yen pairs, I think, and maybe even the Swissy. That's where I will be focusing on. And then you have stock markets, which I think is the most obvious what's going on here with these downtrends and probably continuous downtrend given the state of the world today. Okay, guys, do you have any questions? Let me know. So we have Marvin here in the chat box. Good morning to you, sir. I hope you're doing well, and thanks so much. Yes, had a very good holiday. Very pretty much just waking up in the morning, going to breakfast, after breakfast, hitting the pool, and if we didn't go to the pool, we would go to the beach, and then lunch again, and then back to the pool, reading a book, maybe going to the gym. I actually went to the gym once, so I'm not that good with the gym. That was just pretty much my holiday. Um, so I was away with my wife and my little baby. He's like 14 months, so it was a lot of playing with him as well and just enjoying the sun really and life. Uh, so Andrew Mills asks, what's my outlook for the VIX? Let's take a look at the VIX. Because this is the VIX, and the VIX is, well, uh, it's actually good that you brought this up. I'm gonna show you something different as well. So the VIX itself, the VIX itself is something, it's a range bound sort of time series, and you can see that sort of pushes up sometimes when the market goes a little bit crazy. Now, if someone would say, okay, you want to buy, you want to sell, I would probably say, probably want to not sell and not buy. The market found some support here on May 22nd, and it might go lower a bit, I guess, which is a little bit what stock markets are telling us. But I think this could probably go down and then probably upwards again. And what we added, let's talk a bit about the CNN Fear and Greed Index. So the CNN Fear and Greed Index is an index I used for many times. So it's a combination stock price index. It's a combination of 7 different sub indicators that they combine into some sort of an indicator. Some people like to look at the details. I like to make it less complicated. So I have done a simple back test. You can find unfortunately, you don't find too much data, but you can find old images of this, and you can sort of find data at least for a few years. And then you can just look, okay, so we had a low in, I guess, August 2017, and then you had a lows in beginning of 2018, and by the end of 2018, then you kind of sort of try to look at this time series plus the S&P 500. Now, this index is not good telling you when the market's necessarily overbought. The market can be at extreme greed and overbought for a long period of time without necessarily hitting an actual high, but it's very good at finding lows. And the index, when we're in an overall bull market, it will just go down to maybe 20 and then it goes upwards like that. Whereas when things start to get a little bit more crazy, then it goes much more lower at these extreme levels as we saw in 2018 and 2019. So what it's telling us right now, because we're pretty much here, which is a level of 23, it's telling us right now that the market is not necessarily sufficiently oversold. We still have a bit more to go, and I think if this is managed correctly, uh, hopefully we can get some more juice out of sort of Nasdaq 100 shorts. But then when this starts to hit the lows, I will be very uncomfortable holding Nasdaq 100 shorts. And if we don't have any recession, we're at the lows. Donald Trump tells us, guys, we have a beautiful trade deal with China, and then we'll see that and move potentially. So for now, I think more weakness in stocks. VIX probably going slightly higher, uh, and that's the play I think, which is the obvious play. And again, if we can manage that correctly with good risk reward ratio entries, good stop loss levels, then that could potentially be something. For forex markets, I think again it's going to be a bit choppy. If you want to focus on something, you want to probably focus on the yen pairs. You can also focus a bit on gold. Um, if you want to sort of take advantage of the current market state. Okay, good. We don't have any more questions, so I think we're going to wrap things up. I'll be back tomorrow at the same time at 9:30 a.m. London time. Today, we started a bit later, like an hour, because of was busy in a meeting. But we're gonna wrap things up, guys. Don't forget to hit that like button. It's very easy. Just like that button. Like, click on this like. If you're not subscribing, it's very easy as well. Just create a free YouTube account that gives you the possibilities to talk with me, like Marvin and Andrew did today. You can ask questions. And don't forget to share. It's very important that you do share. When you click on share, you can take that little code. You can put that in your Facebook. You can put that in trading forums. You can put that in different spots because it's really important that you do share. Because it tells us that in essence, what happens is that the guys at ATFX, they look at the figures, they look at the numbers, and they say, okay, so how many people are actually watching your daily presentation? Do we really want you to be doing daily presentations when maybe you can be doing something else? Maybe you can write 2 more articles or 3 more articles. Maybe you're gonna get more views than the videos. So it's that's why it's important that you like. So if you do like it, make sure that you like it. Make sure that you share it, so we can say, look, people actually come here. They look at it, they share, they interact. So let's continue to do more of it. If not, they might say, Alex, your time is probably better spent, doing something else. So if you like it, don't forget to share it. Okay, guys, I'll be back tomorrow. Have a great day, and don't forget to check out my Twitter at AlexFX00. Not being too active there because I've been away, but that should pick up over the next few days. Thanks so much, and have a good day. Bye bye.